Hi, Paul Gerard from Price Accounting Services. Welcome back to this playlist concerning rental property issues and expenses and deductions, etc. This specific video is about borrowing expenses and tax deductions. It's a bit of a complex area and it's a bit of an area where a lot of mistakes get made. And reason why, only 2 years ago, the ATO went through a very comprehensive program of writing to a number of taxpayers and denying their deductions because they had made the mistakes. So let's walk through what those mistakes are and how you can keep your records correct and accurate and do it the right way. So when we talk about borrowing expenses, what are we talking about? Okay, we're talking about fees that you pay a broker, a lender, or their lawyers for creation of a loan. So it can be valuation fees, it can be establishment fees, it could be lender's mortgage insurance, it could be paying the bank solicitors. Oh boy, it goes. It used to include stamp duty on mortgages, but that's been abolished in the last couple of years. So particularly when LMI is involved, these costs can amount to substantial amounts, particularly for property investors who are gearing up to a high level. And because LMI will often be applied if you exceed the 80% loan to valuation ratio. And tip, speak to a broker about all this because it is an area where they can really contribute excellent value. Okay, so borrowing expenses, I have seen so many taxpayers get this wrong. They say you claim them over 5 years. Divided by 5, I claimed 20% this year. That is so wrong, it is just not correct, okay? The correct rule is that you claim the borrowing expenses over 5 years or the term of the loan, whichever is shorter. But that does not mean you claim 20% each year. Okay, it means you claim over 60 months. Now let's use an example that illustrates the point. Let's say I start a loan on the 1st of June 2017. I would claim, and I have $6,000 of borrowing expenses. Therefore, over 60 months, I can claim $100 per month. In this 2017 year, I can claim 1 month $100, not 20%. So by doing it that way, you get the same annual total deduction over the course of the 5-year period. It's going to actually be over 6 years because there'll be 1 month in the first year, and in the 6th or the 5th year, there will be 11 months. So, and then the bits in the middle will all be equal. So that's a really important issue to get right. Now, borrowing expenses also, I see people do our tax checklist and sometimes they'll throw interest. Just remember the borrowing expenses. Interest isn't a borrowing expense, interest is interest. So when you're doing a tax checklist, just make sure you include interest under the interest portion and borrowing expenses. Now, what is really important too is some borrowing expenses are 100% deductible in the year that they're paid. Examples of that include monthly fees. A lot of banks charge $8 a month, and if you've got 2 loans, that can be $16 a month. So watch for that. Annual package fees. Many banks now charge preferred customer package fees of, call it around $400, sometimes $500 per customer, and it's charged on an annual basis. Now, I'm not suggesting that 100%, so in many cases 100% of that cost may be deductible, in other cases it won't. So it's really important that you look at each bank's package and say, what am I utilising in that package? And for example, if you have, let's say, couple A have a package with ANZ Bank and it's $400, and they have their own home loan and they have their investment property loan, it might be that 50% relates to each. So they'll claim $200 borrowing expense for each year for their investment property. Couple B, on the other hand, might only just have a package with Commonwealth Bank and they charge a $400 a year package fee, and they've only got their investment property, in which case 100% will be deductible. So review the use of your package and that will help determine deductibility. The key issue that you also need to consider is when the borrowing changes. The deductions may change. So what are the rules around that? So if we have a loan with Commonwealth Bank and you've got 18 months into the process and you're still repaying it and you refinance that loan, the refinance of that loan will trigger the remaining undeducted borrowing costs to become deductible at that date. Then a secondary issue needs to be considered: are there new borrowing costs for the replacement lender? And if there are, a new 60-month period may commence at that point. But it's really important to consider at that time, what was the purpose for that new borrowing, for that refinance? So if it was just a complete refinance, it's just a change of lender, nothing else, then it still may be applied against the same property. But let's say that the refinance relates to releasing equity so that you can buy property B, a new property. It could be that the old borrowing expense is deductible against the former property, and the new borrowing expenses are only applied to the new property, or a portion, depending on what's required. And you might need some guidance and advice from your advisor on that. That's what we're here for, happy to help. So that covers our borrowing expenses discussion today. Check out our other videos in this series. We've got a lot of them, and you can just run your way through the playlist, or you can just pick and choose as you see fit. Check out our other playlists, subscribe to our channel, and look forward to seeing you again. See you then, bye.